Those scenarios I just discussed are change of control scenarios. Now, over here at Potomac, I deal far less with minority positions. But when you think about a minority investment from a private equity firm, that's typically a larger firm that is looking to, number one, maybe get a little bit of liquidity, take a few bucks out of the business. But really, when folks take on growth equity investment, they're actually looking to grow. They might have a great acquisition opportunity, like Middleby, acquire our largest competitor, right? That's a great opportunity. They might have some AI technological investments that they want to make. They might be building out a sales force. There's a variety of reasons why a firm might tap a private equity firm for a minority growth investment. And so, of course, the capital is extremely a visible aspect of that. But there's also a lot of other important reasons. In resi and commercial services, you might have a $500 million a year in revenue business that would ultimately like to go public. It's really hard going from a privately held business to ultimately taking it public if you have zero experience taking a business public. So sometimes folks will have the aspiration of ultimately taking a business public and say, we need to partner with a private equity firm that does this for a business, a firm that has made a bunch of investments over the years and taken a lot of these companies public, because they're going to understand how to structure the board. They're going to understand how to structure the corporate docs and governance. They're going to be able to bring a lot of other resources and capabilities to help us grow this. And it won't, when it comes time, they will actually lead us down the path to an IPO. So we tend to see that from time to time. Outside of taking chips off the table and getting the old second bite of the apple, why else would you consider partnering with a private equity firm? Well, what do private equity firms bring to the table? The most visible aspect is capital, right? They bring in growth capital, and they bring in diversification in capital for you, the owner. They bring on additional access to capital, right? You own a $100 million commercial services business. You can tap commercial banks, right? You can get capital, but you certainly can't get it as much as a $1 billion private equity firm can. Right? They have lenders on tap. They can very easily tap the debt markets in ways that you can't. And debt is significantly cheaper than equity capital. And if you've got a lot of growth plans, getting an expensive debt might be a great thing for you in order to grow your business. So access to capital. Access to other resources and capabilities. When I look at private equity firms, I'll typically look across their portfolio. And usually private equity firms will have specific concentrations, right? So you might have a firm that focuses on digital marketing. So the private equity firm really has its act together when it comes to digital marketing, and it can apply those resources across its portfolio. So whether it's quick service restaurants and distribution companies and so on and so forth, they've got a lot of capabilities in digital marketing inside the firm that they can apply to their portfolio companies and help them grow. You've got other private equity firms that really have tech expertise, so they can apply technical solutions to portfolio companies. Other private equity firms are really into financial engineering and so on and so forth. So there's various different flavors, but you can bring those capabilities in. Private equity firms, of course, help with aligning of employees and team members. Right? So every time you do a private equity deal, they're going to focus on, okay, this is the management team, this is the employees. Do they have stock options? Do they have equity participation? How do we align the incentives of the actual employees with ownership? Because what we're trying to do here is capital appreciation. We want to make the firm more valuable. And so we want the employees to benefit and actually see a direct line of sight between the hard work that they do and the increasing value that we're creating in the firm. So incentive structures are important. Private equity firms bring those sorts of expertise to the table. Hiring, right? Thinking about like the finance function and how do you set up ERP programs. There's a lot of things that owners of middle market businesses have never done before. And certainly you can go out and hire consultants, but when you partner with a private equity firm, they've tested this stuff across their portfolio and they have these sorts of experts on tap. Private equity firms also bring in operational expertise. They tend to bring in operational experts that are focused on your industry. They'll go out and find former CFOs and former CEOs of the large companies that dominate your industry, and they'll bring them on in as experts, as operating partners. And those guys can provide additional expertise to you, the CEO of a private equity portfolio business, in running your company. A lot of private equity firms operate as clubs. They'll have semi-annual and annual meetings where all the CEOs, CFOs, senior management teams of their portfolio companies get together go out for wine, have a barbecue, spend time together, compare notes on how they're growing their businesses, and trade various different resources and capabilities across the portfolios. We see this quite a bit. And while I think there's a lot of reasons to partner with private equity, there's a lot of reasons not to. And two primary ones are, listen, if you want to own 100% of your business in perpetuity and don't want to take on a partner, private equity is not for you, period. If you're okay with taking in a partner, but you really don't want to have any oversight, private equity is probably not for you as well. Because you're running a middle market business now today. You partner with private equity, even if you own a significant portion of the business, 20, 30, 40%, your majority partner now is going to want monthly reporting in a way that you've never had to do that before. And at bare minimum, they're going to want quarterly reporting, and they're going to set up a formal board, and there's going to be board meetings, and there's going to be compensation committees. Some people get excited about that, and they say, man, I can learn a lot. I've never been part of a board. I've never had all these outside directors providing a lot of expertise and guidance. Other people can't deal with it at all. So depending upon whether or not you want to remain 100% shareholder or whether or not you want any oversight on your day-to-day, that'll help you determine whether private equity is right for you. Later in this series, I'm going to give a few case studies about some things that have really worked out well. And these things don't always work out well. Sometimes things go wrong. Sometimes people partner with private equity firms. They expect to remain the CEO, and it just doesn't work out. Maybe they're not liked. Maybe the board doesn't like them. Maybe they're not happy in general and they get the boot. So that sort of stuff happens, and we're going to talk about it. So if private equity has reached out to you, feel free to reach out to me. You can contact me on the contact form below in the description, as well as you can always reach me on LinkedIn. I'm Giannamore. Thanks for joining me today. I'll see you on the next one.